Significant technological innovation and accompanying cost reductions in components and hardware have revolutionised the space industry over the last decade. Whereas historically constellations of more than just a handful of satellites were prohibitively expensive, the combination of low-cost launch, satellites which can be built at a fraction of the cost, and now in some cases are the size of just a shoebox, but with equal or better functionality, and the use of rockets which can be refurbished and reused, means it is now proving to be very possible to deploy constellations of hundreds of satellites at equivalent expenditure. This is enabling the ability to build platforms onto which new business models and markets are already showing signs of impacting and disrupting areas of traditional industry. Profitable companies with high potential are being formed in areas such as connectivity and telecommunications, through to autonomous systems and logistics, as well as in areas of climate change, weather and agriculture. Today we explore this early stage but hugely interesting area with the co-founder of one of the most prolific VC investors in SpaceTech, Mark Boggett at Seraphim. Welcome to the Investor Insights podcast, hosted by Killick & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killick & Co YouTube channel, or by searching for Killick & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killick.com. Killick & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killick.com. In today's episode, we were joined by Mark Boggett, CEO and co-founder at Seraphim, an investment firm exclusively focused on SpaceTech, which launched the very first space-focused VC fund in 2016, before going on to launch a subsequent private growth fund, and then in 2021, a listed investment company on the London Stock Exchange under ticker SSIT. Across these three vehicles, the asset manager has invested in over 100 business startups and is highly active at the cutting edge of technology in this area via an innovative accelerator program and through co-investment with some of the active participants in the sector. The listed SSIT is another example of a good use of the listed investment company structure. With no borrowing at company level, the company has the ability to take a long-term view with the portfolio and concentrate on maximising value from underlying investments. As we discuss in this episode, the Seraphim strategy is currently heavily focused on areas of nearer-term commercial opportunity, such as digital infrastructure, that in areas of connectivity and telecoms, as well as in areas such as observation. Undeniably, this is still a segment of industry which is nascent, with most companies still in the early stages of their development. However, it is noteworthy that in the company's recent interim results, published earlier this month, they highlighted that many companies within the portfolio are expected on current projections to be fully funded and reach earnings profitability in either this financial year or next. This provides an example of how this segment is driving forward and executing on business plans despite what has been a challenging period for most early-stage growth capital. A difficult environment which is shown no more clearly in the fact that the SSIT share price currently trades on a near 50% discount to current prevailing underlying net asset value. Whilst early in the journey for SpaceTech, nevertheless this is still undoubtedly an area of innovation which is set to have an impact, either in terms of competitive threat or areas of opportunity on many industries around the world. And therefore it is hugely insightful to receive an update on the progress being made within the Seraphim's current portfolio. Mark, good morning. Thank you so much for spending some time today. How are you doing?
Yes, good. Well, thank you for inviting me. I'm looking forward to talking about the trust.
So, but Mark, we've got this kind of standard opening question to these, and it kind of tries to get a bit of an insight into how you go about your work or something you've been looking at recently. I wondered if there's a kind of research project or meeting that you could kind of share an anecdote from, or something you've been looking at, a book or article, anything you could share.
Well, I think a recent event for the space industry, I think probably is something that warrants the answer to that question. There's been a huge event that happened only a weekend ago, and I'm not sure that your listeners will really understand the real impact of this. So why don't I talk about that in the first instance? So this relates to SpaceX, and it relates to the new giant rocket ship that they've created, which is called Starship. And I'm sure some of your clients saw the incredible feat of this giant rocket lifting off into space, and then minutes afterwards, the actual thruster coming back down and landing and being captured within these chopsticks so that it can be reused. So it's an amazing visual feat, but what it actually means is huge. So this is the largest rocket that's ever been produced. Now, SpaceX has already revolutionized the space industry with its Falcon 9, its reusability. It's reduced the cost of taking anything to space by 100x. Rocket launches used to happen once a month. They're now happening virtually every day. But this vehicle is the next workhorse for the space industry. And just to sort of put that into perspective, it can carry 100 tons. It can carry 100 crew. You know, these are sort of levels that have never ever been achieved before. But what is particularly exciting about this is that it opens up space to be able to take much more material into space. So we're still years away from really being able to go to the moon, mine whatever we can find, put it through a 3D printed machine, and get useful products out of the other end. So at least for the next 5 to 10 years, the things that we're really taking into space, we really need to take from the ground. So this means that we're just opening up a new era of really being able to build infrastructure in space, where business cases start to close for things that were previously inconceivable. So these are sort of things like data centers in space, manufacturing in space, lifting whole dirty industries that are polluting our planet and moving them into the space environment so that we can still get those goods or services, but without hurting our planet. So this is what this event heralded last weekend. It was actually the 5th launch of this vehicle, but it was the first time that they'd shown that the reusability can work. And that really is the key to bringing down that price further. So we don't actually know what the new pricing is of this vehicle, but the market's best guess is that it's going to halve again. So this is reducing the cost, increasing the cadence and volume that really is going to create this sort of next era of commercialization of space.
Yeah, no, great. Thank you for showing that. Yeah, incredible footage of those chopsticks in action. Yeah, we're well worth a look if you haven't seen that.
Yeah.
No, thank you. Mark, I thought just to kind of frame the rest of this discussion, really, I wondered if I could ask you to, well, we've often heard you describe the portfolio kind of segmenting it into the ecosystems or different kind of subsectors of what you actually mean by space tech.
Yeah.
I wondered if you could maybe ask you to run through maybe a selection or the kind of major subsectors to give a kind of sense of the variety of different types of technology, what we're talking about here.
Yeah. So I will do, but can I just get to that with one previous sort of answer to that question? Because we break space down into 3 parts. The first part is here and today. It's building this digital infrastructure with hundreds or thousands of small satellites that are covering our Earth, creating a digital infrastructure and providing data and communication capability that we've not seen before. That's where we are today. That's where we're mostly invested into. And I'll come back and dig into that a little bit in a second. The next phase of growth, which I've actually just alluded to in relation to SpaceX's new Starship, this is about building infrastructure in space. This is the next phase of development for space. And this is about things like data centers, as I mentioned, those cell towers, manufacturing, big industrial activity in space. And then the next stage is about the moon as a stepping stone for Mars, all the technologies that are required for permanent habitation, resource mining in space, space travel, all of those sorts of things. So those are the three parts. We don't invest in that exciting latter part because, it's really exciting, lots of cool innovation, but there really isn't a commercial market for it. And if there was, it's not really for the next 10 years or so. So we don't invest in that part of the market. We focus on the digital infrastructure and everything that's being involved around that, because there are customers for that data, there are customers for that technology. So it's about space being able to help address problems on Earth. That's what we focus on. So to answer your question, where are we focused? Well, let me just sort of take you through the sort of the range of opportunity in space. First of all, you've got building satellites and everything that relates to space, components of those areas. We don't really invest in this part of the market, largely because we see it challenging for a component business to grow to a scale where it could be a $1 billion enterprise. So we don't really focus on that. They tend to be very competitive and relatively small companies. So that's not an area that we're focused on. Next of all, you've got the launch. Now, SpaceX has really led this launch, and they've got access to almost free money, and everything that they've been doing exceptionally well. There's another 100 space rocket launch companies out there. There's one in every country, because governments really want to own this type of capability for their own military purposes. But we shy away from launch. We think that it's a crowded market. It's a race to the bottom on pricing. So we don't invest in launch. So one of the things that really surprises people when they think about the fact that we're a space-focused fund, that we don't invest in launch and we don't invest in anything to do with the moon, Mars, or space travel or anything like that. We're really just focused on space, looking down at Earth, where it can provide capability for end markets that exist today. So the next phase is around what we call platform, which is another word for constellations. So these are the companies that are putting up the hundreds or even thousands of satellites that each have a different capability around gathering data or communications. That's where most of our investment takes place. We really like vertically integrated constellations that develop their own satellites, build their own satellites, operate their own satellites, develop their own software and AI capability, and then have their relationships directly with their end customers, like insurance or real estate or oil and gas. So that's really where we focus most of our attention. Next of all, you've got what we call downlink. So this is about the movement of data. So huge amounts of data collected about our planet every day. How is that secured? And how is that moved around in space, but also down to the ground? Many applications with the highest value are about real-time data. So how can you reduce that latency to provide these insights on a real-time basis? Think about GPS. If that wasn't real-time, it wouldn't really have very much value. And many of the different types of sensors that we look at, the value increases as it moves closer to real-time data. So then next of all, you've got data analysis. So this is companies that are not putting satellites in space. They're relying on data that's being generated by others, but then they are using that data and applying AI and then applying that to different markets like insurance, for example. Then next of all, you've got the product companies. They are using data from space, but as just one feed. So they'll also take terrestrial data. So the business isn't focused about space. So Uber would be a good example of this. It takes a data feed using GPS, but the business is much broader than being a space business. So we call that a product business. So those are the different types of business that we look to invest in, and the different segments that we are investing into or not investing into.
That's really helpful. I think it's really important that where you're targeting in the value chain to get that kind of commercial scale. That's kind of a really important point. Okay, thank you for that.
That's right. And actually, importantly, Gordon, that comes through in our recent full year results, where we talk about the number of companies that are now hitting profitability.
Yeah.
And it's because we're focusing on these markets where there is a real market today rather than a really exciting market for the future.
I wondered if we could maybe delve into one company. You've used Skylo as a kind of investment case in some of your recent presentations. I wondered if you could maybe ask you to kind of summarize the kind of business model or the investment case of that company briefly, just to kind of give us a sense of kind of it's quite a good example of a business that you'd look at.
Yes. So if anyone's got an iPhone or a recent iPhone, they'll recognize that when they're out of connectivity, that they're now able to connect to make an SOS call via a satellite. And the whole mobile market really wanted to get this capability, but Apple got there first, sort of 18 months ahead of everybody else. So the rest of the mobile market has been desperate to get this capability. And that's exactly what Skylo provide. They're addressing the problem of connectivity gaps in mobile networks outside of the terrestrial networks, where connectivity is not available because it's too costly to cover with cell towers. So the problem is that in this connected world, consumers and businesses are demanding always-on solutions. They don't care that they're in a remote region. They need this always-on capability. So this is what Skylo solves. They've got a virtual radio access network, so it's largely software, and that integrates to non-terrestrial networks. And non-terrestrial networks, I mean geostationary satellites in space. So what geostationary is where you've got a satellite above London that provides communication. As the world turns, the satellite stays in position so that it's always above London. So that's the geostationary market. It's the legacy telecommunications market. So what they're doing is they're plugging into this capability, and then they are making that work with the terrestrial mobile system. So any phone that has the latest industry standard chipset. So these are the chips that came out in the second half of this year that are now pretty much in every smartphone. That allows that phone to automatically roam onto the Skylo network when they're outside of their terrestrial cover-up. So that offers seamless connectivity. So this is a $1 billion market opportunity. Today, it's focused on providing services just for emergency, but it has the potential to be ginormous if they expand into voice and other data services. So we see the market size sort of increasing by tenfold. So they've signed up some really important customers already. Google are exclusively using this for their flagship Pixel phones, first of all for SOS services, but starting next year, they'll then enable text messaging, and then WhatsApp messaging. Verizon have also signed up for exactly the same, and there are many other mobile network operators that are in process to get signed up as well. This is a important additional connectivity capability that they can provide to their customers. Everyone will sign up to get this connectivity, first of all, for an emergency perspective, but second of all, to be able to send text messages when you're on an aeroplane or wherever you are in whichever part of the world.
Yeah, no, thank you for that. No, really good example. A good example of the kind of corporate opportunity there. But I guess my next question is around kind of government customers, because I know that's another kind of key driver to the sector. More countries looking to build out kind of sovereign space capabilities. Could I ask you to maybe, again, just briefly, some examples of companies that are kind of servicing that type of demand?
Yeah, so there's sort of two elements to this. One is that the cost of operating in space has come down by 100x. So the satellites are 100th of the price, the launch is 100th of the price, which means that there's been a leveling of the playing field. Previously, space was a market that was really only open to the most developed and richest countries. And often they worked together to finance activity in space to sort of spread the cost out and risk. Now, this is really open to any country. So any country can build its own GPS network, can have its own security network, can have its own communications network, and the myriad of other things. So this is exactly what's happening around the world now, where individual countries are looking for this capability. So, for example, our biggest portfolio company that's worth 20% of NAV, which is called ISI, is a great example. They're providing Earth observation capability to a range of governments. I think they've just announced one in the Middle East. They've just announced Greece. So what's effectively happening is that individual countries are acquiring a range of their satellites that they can then operate and use themselves, but it fits within their broader constellation, so that as they need to sort of switch up capability, they can do that by dialing into the rest of the constellation. But there is a core element of the constellation that effectively governments can own themselves. So this is one of the sort of hybrid solutions that's popular in the market at the moment. And then the other big driver, of course, is through geopolitics. We've got some challenging wars going on around the world, and that's really forced countries globally to look at their capability on defence and start to accept the fact that they've been under-investing for decades. The other thing that defence hadn't done is gone through a sort of period of digitisation. We've seen industry go through digitisation, and it's still really going through it now, but defence organisations hadn't yet started that. So these wars have actually led to a rapid development of digitisation. And what we're finding and what our companies are finding is that data and communications from space at low cost, high resolution are right at the tip of the spear of what governments are looking for their defence capability. So this is part of the reason why so many of our companies that defence has become the biggest customer over the last few years. Only a very small number of our actual companies would consider themselves to be defence companies, but space is inherently dual use. So as a consequence, defence is a market that is readily available to them. And that has become the key driver during the course of the last couple of years. About 70% of total revenues are actually coming from defence customers.
Yeah, no, thank you for that. So I think your answers to the last few questions have really set the scene for kind of the long-term investment case here, the kind of drivers behind it. I wondered if we could maybe move on to, I mean, it has been a kind of challenging environment for kind of all kind of growth capital. The space sector's kind of not been immune to that, obviously. We're catching you just in the week that you published results, and one of the kind of the key statistics in those results was the fact that portfolio constituents have on aggregate raised, I think it was $900 million of additional funding over the last year, a really quite significant kind of number. I wonder if I could kind of ask you to give a sense of the kind of health of the funding environment that you're seeing in the sector at the moment.
Yeah, so if you compare the amount of money that's being invested globally into the space sector to the rest of the technology market, space has really followed the same trajectory that we've seen in the sort of macroeconomic environment of a sell-off, a reduction in risk appetite in 2021, 2022. But where space has bucked the trend in 2023 is that we've seen 5 quarters of growth coming through up to date in 2024, where there has been a massive return to investment coming into the sector. And just quite simply, this money is looking to follow the dollars that are in the budgets of defence. So it's big private equity funds that are coming in, for example, and really starting to focus on space as a long-term opportunity. So within that environment, our companies have been readily able to access capital to enable them to be able to execute against their plans. So as you rightly said, 900 million raised. We had 17 companies in the portfolio successfully closing funding rounds. We had companies in the portfolio like ISI that were setting records of levels of funding for Europe. The D-Orbit was in the top 10 of all deals done globally in the space sector in the last year. But the thing that I think is really really exciting, because this is happening faster than we envisaged, is how quickly that is leading to our companies becoming EBITDA positive. So a year ago, only 2% of our companies were fully funded. And in our most recent results to the 30th of June that we've just released, 60% of the companies are either profitable now, or they've raised sufficient capital under the management's own projections to reach profitability before they need to ever raise any more money. Now, this is a huge change that's happened to our portfolio. It's not really reflected in our NAV and increase in valuation, but what it does do is it provides the capability to these companies to continue to scale, but to do so in a profitable way. So that's really the big thing that this $900 million is really going to enable for this portfolio for the year or two ahead. Is that acceleration of growth.
Yeah, no, thank you for that. Yeah, really important step when those companies start to become earnings positive, for sure. Yeah.
Yeah. Well, for one, it makes them so that there's a possibility that they can IPO. It makes them more of a target for M&A. So it really changes the sort of dynamics of the relevance of that portfolio to the rest of the market.
Yeah, lots more eyes on those sorts of businesses. Yeah, for sure. Mark, the other kind of issue with this kind of change in economic backdrop is the kind of derating of the company's shares itself, and that's going to be a kind of across the board of all of the kind of venture capital, growth capital kind of peers. It's just been a feature of things. But I mean, what it has done is kind of bring in scrutiny on kind of capital allocation and the kind of challenges of that. Could I ask kind of how you're kind of balancing the need for kind of working capital, buybacks, and also kind of follow on and new investments? How are you kind of balancing that at the moment?
Yeah, it's been a really challenging tightrope that we continue to walk on. There is because of the discount that we suffer at the moment. Today we're on a 45% discount. Our peer group are on about a 35% discount, but there are members of our peer group that are sort of on 50% plus. So we don't particularly think that the discount directly relates to us. It's more of a sort of market issue. But what it means is that we've not been able to raise any more money for the trust, and that is a challenge, because our companies require large amounts of money to continue to expand their opportunities. And thankfully, that money's been available, even though it's not coming from us. So what we've really had to do is we've had to really balance about allocating funds for particular companies. We are the leading space investor globally. If there is a funding round where we don't participate, it can really send a negative signal to the other shareholders or new investors that might be wanted to come in and finance that round. So we have to reserve capital for certain companies where there's that level of sensitivity. So we've now got to the stage where 60% of the companies are moving into an era where they are fully funded. So that becomes less of a risk. But that's been a sort of part of our sort of careful management during the course of the last year. We have listed portfolio companies, which are obviously a source of liquidity, and we've demonstrated a willingness to use that. So one of our portfolio companies, Astroscale, IPO'd on the Tokyo Stock Exchange in June, and we fought hard not to be locked in by that IPO, and we took advantage of great rallies in the price post the IPO to sell down our holdings. So we've sold the vast majority of that holding in order to release some for much needed liquidity. So we've got 27 million in cash. It's nearly 12% of NAV. And we like to sort of hold around that amount because we've got that sort of allocated against various different portfolio companies during the course of the next year. The other thing, of course, is that hopefully from the brief description that I've given of the market, there's just an immense amount of opportunity. And it's a really challenging time to have a limited cash budget to be able to invest into new investments. Skylo is a great example of the type of company. We tracked it for 3 years. We got the opportunity to invest. it took advantage of really attractive pricing because of the macroeconomic backdrop. And yet we were only able to put in a relatively small amount of money as a consequence. So there are other opportunities that look like that in terms of massive upside, relatively low risk. We've got real confidence in the position in the market. So we will hope to continue making one or two investments like that in the period before there's a recovery in sentiment across the investment trust market, a reduction in the discounts that could potentially lead to us raising some more money. So buybacks are always obviously a feature of the discussion with the board. We did do a buyback last year when the share price got to sort of 30 pence, 70+% discount. And we wanted to send out a message to the market to say, look, this just doesn't make sense. We're in a growth market. All the evidence is there that it's growing quickly. We've got the leading assets within there that are thriving. I mean, for example, our top 10 companies on average grew by 72% in the last year. If you did that on a weighted average basis, it's 224%. So that means that our bigger companies are performing far better than our smaller companies. So on all of these measures that are readily available, investors who care to look in some depth can see that the portfolio is in good shape. So we wanted to send that message out by making a small buyback that we did, and we did that last year. So we are willing to do that. But whilst it makes sense to buy back our own shares and to profit from doing that, that investment isn't the same level of investment as us investing into new companies like Skylo, where we're expecting to make 10 times or more our money as a consequence of backing businesses like that. And that's what we're in the business to do. So, we find it challenging to think about using our cash resources for buying back our shares rather than supporting the portfolio or for investing into new, amazing, late stage, on the pathway to profitability companies to join the portfolio. But it is in view every quarter, and we will actively look to pull the levers on that kind of activity if we see share price just getting moving away from our peer group as well. If we're within the sort of peer group, I think that we feel more confident. If we're sort of extending on our own for no good reason, then I think that's more of a justification for thinking about things like share buybacks.
Yeah, that's clear. And I thank you for running through that.
Can I just make one more point, Gordon, that I didn't cover there, which is that SpaceX is the most active private company globally. There is a giant secondary market for private companies, and space companies are hugely in demand. So all of the companies that are sort of our biggest companies, the companies that are category leaders within different parts of the space market, there's a very vibrant and liquid secondary market for those companies. So, for example, whilst our biggest company, ISI, is a private company, 20% of NAV we have there at the moment, it's our best performing company. But if we wanted to sell shares in that company, it would take us about a week to do so. There's a really liquid market to be able to sell secondaries on that. So that's the other thing that we've got that we can use if we felt that we wanted to access some more liquidity before there's a return to sentiment and a closing of the discount gap.
Yeah, no, an important point. Yeah, not often understood that kind of secondary market in private assets. Mark, our kind of last question is another standard question, and it asks the speaker for their kind of highest conviction area at the moment. I'm conscious you've kind of mentioned a few kind of exciting opportunities as we've gone through, but if there was kind of one area of SpaceTech or one company that you'd highlight.
Yeah. So let me give you a short example of why my conviction is so high. So I'll take a sort of step back to answer this. So okay. Everyone's familiar with GPS. So it's the blue dot in your mobile phone, and it helps you in your everyday life. It's also used by virtually every company in every industry in a myriad of different ways, and it's turned entire industries like the taxi industry upside down with companies like the advent of Uber. Well, that blue dot only has actually 3 pieces of information: longitude, latitude, and time. So if I look then at our portfolio companies, rather than a blue dot, they have a green dot. But this green dot has a lot more information. So for example, and again, I'll use the example of ISAC because it's easiest to understand, but they have radar satellites. Radar enables them to be able to see the ground in 50 centimeter resolution, day or night, and it can look through cloud and any weather. And with their current constellation of satellites, they can see every square meter of the Earth every 2 hours. And they then run change detection algorithms to determine how that square meter of Earth has changed. And of course, as they build out their constellation, that 2 hours is going to go down to 1 hour, down to half an hour, down to 10 minutes, and so on. So ultimately, what we're heading towards is a green dot in your mobile phone that has hundreds of pieces of information about what's happening right now on that green dot and everything in the local vicinity, but also historically what happened on that green dot and how it's changed over time. So if you can think about in fact, I'm sure there are giant opportunities for how this is going to be used that we can't even conceive today, in the same way that there was when the internet was founded and you couldn't think about, giant companies like Salesforce that might exist because of the capability that provides. We are absolutely confident that this whole rich world of capability that's going to leverage that green dot, that is going to make our lives better, is going to improve industry, it's going to increase costs, lower costs, improve service for customers, and make companies differentiated, but also improve our lives. So I think what folks are really going to start to see during the course of the next few years are these types of capabilities coming into their own cell phone and finding it, helps you in your everyday life. And that could be as simple as, being able to find a parking spot, in close to real time, with this functionality being picked up and used within Waze or Google Maps and that type of thing. So this is quickly going to have an impact on us all. So yeah, Earth observation and how it is really going to impact our everyday life is the thing that excites me the most.
Yeah, no, absolutely. Your mind starts to wander to all of those areas like the weather or agriculture or climate change that it could kind of disrupt and create new markets from. So yeah, no, it's a very exciting area. Mark, thank you so much for your time. It's always really interesting to talk through the portfolio with you. Thank you.
Well, thank you for inviting me today. I hope that was of interest to your clients.
Thank you for listening to the Investor Insights podcast, hosted by Killick & Co. You can get in contact using our podcast email address, investorinsights@killick.com, for more information on any of the topics discussed, or for further details on the services offered by Killick & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killick & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.